One wrong life insurance decision could leave your family hundreds of thousands of dollars short when they need help the most. And surprisingly, most people have absolutely no idea how to calculate the right amount. Some people buy too little coverage. Others pay for far more than they actually need. The goal isn't buying the biggest policy available. The goal is buying the right policy. To figure that out, you first need to understand what life insurance is actually designed to cover. For most families, life insurance starts with replacing lost income. If your paycheck disappeared tomorrow, could your family still pay for housing, food, and everyday expenses? That's why income replacement is usually the biggest piece of the calculation. Next comes debt, things like mortgages, auto loans, and other financial obligations. Life insurance can prevent those debts from becoming a burden for the people you leave behind. Many families also want coverage to help fund future goals like college education or retirement planning. So before choosing a number, you need to understand the four major categories that shape your coverage needs. The fourth category many people forget is final expenses. Funeral costs, medical bills, and estate settlement expenses can arrive long before a family is financially prepared. Once you understand what needs to be covered, the next question becomes much more personal. Two families earning the exact same income can need completely different amounts of life insurance. The number and age of your dependents often play a major role in determining coverage needs. Younger children typically mean a longer protection window because financial support lasts for more years. Now let's talk about the largest driver of coverage for most households: income replacement. A practical approach is estimating how much annual income your family would need if you were no longer there. You then multiply that amount by the number of years your family would realistically need support. Next, add one-time obligations such as mortgages, auto loans, and other outstanding debts. But here's where many people make a mistake. They forget to subtract resources that already exist. Savings accounts, investments, employer benefits, and existing life insurance can all reduce the amount of coverage you actually need. At this point, many people start looking for shortcuts, and that's where mistakes often happen. You've probably heard advice like buying 10 times your annual income. The problem is that simple shortcuts don't know your mortgage, your children, your saving, or your goals. That's why a personalized calculation almost always produces a better answer. Start with income replacement, add debts, add future goals, then subtract available resources. When you follow that process, you end up with a coverage range you can actually explain and defend. Once you know the amount, the next decision is how long the protection should last. For many families, term life insurance aligns perfectly with mortgages, dependent children, and working years. The best policy isn't always the biggest policy. It's the policy you can comfortably keep in force. And remember, life insurance isn't a one-time decision. Marriage, children, income changes, and new debts can all change the number. If you're ready to find the coverage that's right for you, get a free quote from Quote Maestro today.